Good afternoon, everybody, and welcome to the latest in our event in our series of professional advisors working lunches. Today, we're partnering with our good friends at Schroders. I'm Andrew O'Kelly with Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me just quickly run through the usual housekeeping. Your microphones and cameras are currently switched off. And we'd appreciate it if you'd keep them that way. It certainly ensures that there's no background noise, so our speakers can be heard more clearly. I should also inform you that this session is being recorded, and as usual, today's working lunch will qualify for 1 hour of CPD. And we'll be sending you your proof of attendance along with a link to the recording, which will arrive in your inboxes some point tomorrow. And do please feel free to share that with your colleagues. Now, reaching net zero, or even getting close to it, is a massive undertaking, and it'll require the involvement and cooperation of governments, businesses and individuals on a global scale. And as I speak now, professional advisors in the midst of our ESG roadshow, where the asset management community are talking to advisors about their approach to responsible investing in the push towards the ultimate goal of net zero. But how can advisor firms play their part? If net zero is to become a reality, we all have to be prepared to walk the walk, don't we? Well, I'm delighted to be joined today by two expert speakers from Schroders who offer some practical and simple solutions to the challenges of decarbonisation. Gillian Hepburn, the Head of Intermediary Solutions, and Ben Popatlal, the multi-asset strategist, will discuss what it means for advisors and their clients and how to factor this into investment portfolios. They'll also be introducing a really interesting new scorecard, which Schroders has developed to help advisors consider sustainability practices within their own businesses. Do feel free to put any and all of your questions to our guests using the chat function, which you'll find at the bottom of your screen. And if you wish to remain anonymous, simply select my name from the drop-down list in the chat box before you type your message. So only I can see it, but I will then obviously relay it to our speakers. And also, as questions come to your mind, don't wait for Q&A at the end, just type them as we go. So just before I hand over to Gillian, let me quickly run you through our learning objectives for today's session. By the end of the presentation, you should be able to consider the sustainable credentials of your business and why this might be helpful. You should be able to explain what net zero really means and why it's important. Understand the impact that this could have on client portfolios, and identify why we can't reach net zero today. Okay, so that's the CII, PFS and CPD covered. Let's now hear from Gillian Hepburn from Schroders. Afternoon, Gillian.
Afternoon, Andrew, and I'm absolutely delighted to be joining you this afternoon to talk about, first up, assessing the sustainability criteria of businesses. And this was something that we launched earlier in the year at the Sustainable Investment Festival. So I'm going to talk a little bit about the background to sustainability and then cover the scorecard that we've launched that advisors can take part in and talk a little bit about why we've done it. Just some slight background in terms of sustainability. We think of sustainability at Schroders as a third dimension when we're investing in companies. So we look at returns and the risks, but we also look at the impact that these businesses have. And that's important to us because we're all aware that we have lots of challenges to try and address in terms of people and planet. And to address these, this won't happen by government investment alone. And as the holders of capital and as advisors of the directors of capital, we believe that we can all play a part in trying to address some of these challenges. And they're many and varied. And one of the things that we've thought about when we put together the scorecard was not just about the environmental factors. But sustainable flows are continuing to remain resilient, as you can see from this graph here. And what we're still seeing is demand from clients in relation to sustainable investments. So So I mentioned that Schroders have a range of tools that we use within our investment teams to try and identify the sustainability of businesses. So it's a proprietary toolkit that we use when we look at businesses. And they comprise a number of different tools, but some of the ones that you might have heard us talk about are an impact measurement tool, so SustainX, and I'll talk a little bit about that. ThemeX, which looks at different themes and looks at UN Sustainable Development Goals, for example, and then also climate change. How do we measure that? We have dashboards and lots of research that feeds into what we do there. In terms of SustainX in particular, what we did is we thought about that tool and we thought about how we use that when we review the companies that we invest in, and we thought maybe we could apply that in a very light and in a very slightly different way, but with the same principles, to advisor businesses, to think about the sustainability credentials and why that might be important and why that might be helpful. And we thought, well, actually, maybe it helps in terms of demonstrating walking the talk with regards to sustainability. And I use the example of an advisor that I met recently where we were talking about sustainability, yet behind him he had a table full of plastic water bottles. Now it might seem quite a simple example, but actually when we talked about it, he said, you know, this isn't great and I need to make some changes in the business. So it might drive a little bit of change. Does having the scorecard in place and thinking about credentials of your own business potentially help with engaging clients in a slightly different way? I always know that when I speak to advisors, they like to know how everybody else is doing. And we thought, well, maybe it might help advisors benchmark themselves against other businesses in terms of sustainability. I've talked a little bit about driving change, and certainly the advisors that we've worked with already have come back to us and said, you made us think a little bit differently about our business, and we're thinking about implementing some changes, and we'll talk a little about that. I think recruiting and retaining talent is also an area that we see more sustainable businesses find this at times easier to achieve. A great statistic I read recently, so for many of you who might know me, you know that I'm a bit of a stats and research buff. There was an interesting statistic that said that 50% of people aged between 25 and 38 would quit their job and move to a more sustainable business if that option was available. Now, many advisors tell me that recruiting and retaining talent can be really challenging, so maybe thinking about sustainability criteria could help here. And then lastly, maximising the value of the business. You know, many advisors, as we know, are looking for an exit strategy, and perhaps running a business where the sustainability credentials are high could help in terms of maximising valuation. So just some areas that we thought about when we were developing the scorecard. In terms of what our SustainX tool does, really simply, it looks at the positives and the negatives in terms of how a business can contribute towards society. And what we do is we think of those in terms of debits and credits when we're analysing a business to invest in. And these are areas which are not often reflected in financial statements. So again, we thought about the research that we undertake with companies and how we might be able to apply that. And within our own tool, we look at various areas that we've identified of business activities where we can measure these sort of positives and negatives. And you'll see them on the slide here. And a very simple example of how our SustainX tool works is we look at the positive contributions, so salaries and benefits, for example, donations, training, innovation, and we add those up, and then we deduct any of the detractors, so things like carbon emissions, water use. And then we very simply add the positives and the negatives, and I'm always wary. I've got Ben with me today who's probably thinking this is a very simplistic explanation, but it works for me. We take the positives and negatives and we come up with a score which enables us to benchmark companies against each other. And we thought, actually, maybe if we could apply similar principles to advisor businesses, they might find that of some help. So the scorecard, we devised this in a way that it should be easy for advisors to answer, maybe a bit thought-provoking, interesting to debate. And we've already seen advisor businesses telling us that by using it within the business, it created a little bit of debate. It's only a starting point, but it does also, and importantly, consider ESG factors. And on the left-hand side there, you'll see a shot of the scorecard itself. And we can issue that out to anybody who wants a copy of it, but also maybe within our follow-up. Very simply, 20 questions that can be answered A, B, or C. And the context on the right-hand side shows that advisors are still telling us that, that their level of confidence in talking about sustainability is a bit mixed. So anything that we can do to help that has got to be a good thing. I thought I would just very quickly cover just a few of the questions that we asked within the scorecard, just to give you who are online today just a bit of a feel for some of the areas that it covers. So the first one we asked, one of the questions talks about, does your office use renewable energy providers? We're not going to do it live today. Often when we present this at events, we use Slido, and then it's great because we can see how everybody is voting in terms of the answer and have a discussion about it. But just as an example, recently when we asked this question, 40% of advisors said yes, 20% said they were reviewing it, and 40% said no, they don't use providers. We think that using renewable energy providers is important in terms of thinking about the energy system and how we decarbonise, how we can use more electricity in terms of energy use and increase the efficiency of how we consume energy. And also it's important to understand that renewable energy is now much more cost competitive with conventional sources of power. So it's something to think about within the business. Another question we ask is about plastics. This one's always answered particularly well. Have advisors reduced single-use plastic in the business? And again, going back to a recent event, 63% of advisors said yes, they had reduced their use of single-use plastics. Now, why is that important? Well, if we don't take action by 2050, which isn't that long, we are likely to see more plastic in the ocean than fish. And I always think that's a really sobering statistic to think about. And it's certainly not a world that I want to bring my children up in, and maybe my potential grandchildren. So again, plastic's really important. And we always feel that simple steps can make a big difference. This is a screenshot from our canteen. Clearly it's been tidied up, but it just shows what we're trying to do within Schroders in terms of addressing how we recycle waste and how we encourage staff to think about not just plastics but recycling, which is one of the other questions in the survey. We then ask about carbon offsetting, and Ben with me today will talk about this in a little bit more detail. But this is a really interesting question because we ask advisors about, do you carbon offset and reduce emissions? And 53% of advisors have told us that they want to learn more about this area. How can they actually think about decarbonisation and carbon offsets? And one of the things to think about is, what do we actually mean by net zero? Because often when I ask people, I don't think they're entirely sure about what it means. So this slide gives a really good description about net zero. And I think it's that middle point there. We're trying to look at reducing the amount of greenhouse gases that we emit so that they no longer exceed what can be absorbed. And that's how the net zero calculation is done. But Ben will talk a little bit more about that later. But in terms of our own path to net zero at Schroders, we think about that in two ways. One is on the right-hand side, how do we transition our operations? And how do we do things like reducing business travel, as an example? And I gave the example recently, some of you might have seen an article about Peter Harrison, our group CEO, who appeared in a meeting with our US team, but didn't fly to the US. He actually appeared as a hologram. So we're trying to think of new and innovative ways of reducing and avoiding where we can excess business travel. But also we work in terms of transitioning our clients' investments, both to deliver value over the long term, but how can we look at the client investments and transition those and take a solutions approach to addressing net zero. And Ben will cover that in a minute or two. We then move on to questions on the scorecard around the S and the G. And this one's always really interesting. Do you track the gender pay gap and actively address any discrepancies? And I am very, very aware that many of the advisor businesses that we work with are very small, often maybe 1 or 2 person, and then therefore it would be quite difficult to track the gender pay gap. But maybe for the slightly larger businesses, it's something to think about. Often the response to this is, no, we don't do it because it's not a legal requirement. Now, we all know that the legal requirement for addressing gender pay gap or reporting on it is 250 people. So many, if not the vast majority of advisor businesses, don't fall into that category. And we're aware that there will be regulation reducing that number to about 100, but that still won't cover most of the advisor businesses, certainly not a lot of the businesses that I work with. But I suppose our message here is back to that recruiting and attracting and retaining talent. If we've got a bright young thing sitting in front of us, maybe a potential power planner who asks, does everybody in this business get paid the same for the same role? And our answer is, no, we don't review it because it's not a legal requirement. Maybe they're then more likely, back to my 50% of young people moving to a more sustainable business, that maybe they're quite likely to go to a different advisor business who does actually think about the gender pay gap. So just something to consider there. And similarly with the questioning a D&I policy in the business, 24% of advisors in our recent survey said, this is something that we're actually working on and we need a bit of help. But 14% said, no, we weren't looking at a D&I policy. Now, this is where operating a scorecard with advisors has been really helpful, because we've identified where we can deliver further help, not just in terms of understanding net zero and carbon emissions, but can we, as Schroders, which has a significant HR department, colleagues in HR, to deliver some one-pagers to help smaller businesses think about gender pay gap and D&I policies. But it's interesting in terms of thinking of this in the context of the social and governance factors. And this is a slide that I've often used from our advisor survey. So this was our survey back in November, when we asked advisors about the relative importance of the ESG factors. And on the left-hand side, we asked about how do you think the relative importance is for clients, where you'll see very strongly, it's still the E for environmental in that left column that seems to be most important. But actually what advisors are looking at on the right-hand side is a more even spread, I think, of the E, the G, S and the G factors. So there seems to be a much broader understanding of the interplay of each of these factors when thinking about sustainability and ESG. And I really like this slide, which is from our Global Investor Survey last year, and we're just in the process of releasing this year's results, where we ask clients, when might you withdraw your investment? And interestingly, we're looking at major scandals here, a financial or accounting scandal was at 59%, but second, and actually first equal, was a human rights scandal. So clearly we're seeing people think a little bit differently about their investments and the companies that they're investing in. Now, I thought that was an interesting slide just to share, where we're seeing certainly changes coming through. The next question was about sustainability preferences. So does your advice process ask clients about sustainability preferences? And it's probably no big surprise that 75% of advisors said, yes, it does now. And we're absolutely seeing that transition take place, where the majority of advisors are now asking about sustainability preferences. Although a number did say, can you just give us a little bit of help on this? Interestingly, our May survey identified that 70% of advisors are now talking to clients about sustainability preferences, and we're very keen to help out here. So again, if you are interested, do get in touch and we can share some of the documentation that we've produced with you. The graph here on the left, we also asked about product labelling, and we're all waiting on the new regulations to come into force. So again, once we hear more about that in the UK market, we'll be out hopefully running webinars and helping you understand what's happening there. One of the things that has happened though in the last couple of years is that advisors started to think more about working with asset managers who reinforce or who actively engage with the companies that they invest in. And this chart on the bottom just demonstrates that 90% of advisors are now in that position. They want to deal with an asset manager who actively engages with company management. And again, we've done some webinars on this, but we can share information if that's helpful for you. Our impact reporting that we use for our sustainable models does cover some of this content in terms of positive impact that's demonstrated. You'll see on the top right, we actually measure using our SustainX tools the positive and the negative contributors to the portfolios and to the companies that we invest in, and also alignment to the Sustainable Development Goals. But one of the things that I would like to see over the course of the next year is how can we demonstrate the engagements that we're having with companies and the difference that that is actually making. The final question I'm just going to cover today is we asked about training and the level of training that advisors are giving staff in terms of sustainability. And interestingly, 40% of advisors said that in the last year they delivered 3 hours or more to staff in relation to sustainability. And I guess what I'm just keen to point out today is that again, Schroders can help with some of this. We have got face-to-face training programs and we are delivering some online training as well. We've got an introduction to sustainability that we can deliver. We've just finished the pilot for that. So we'll be launching that and making that available. But we've also got some great guides. We have an A to Z of sustainable investment terms, and that can be used directly with your clients. And we've also got a guide to net zero, which has been really popular with advisors. So again, any of that content is available for you. Hopefully that's given you a bit of an indication of what we're doing with the Sustainability Scorecard, and I'm absolutely delighted to share it with anybody and walk them through it, but we will make the scorecard available. But one of the things that we are doing is for anybody who goes through the full 20 questions online, and let me just point out, we don't collect your data, so we don't collect any information about who you are, but it's just really helpful for benchmarking purposes. But for anybody who does complete the survey online, we actually make a donation to the Felix Project, which is one of our charities where we support vulnerable people by redistributing surplus food from supermarkets and restaurants and help. There's a QR code here if anybody who also wants to contribute and make a donation. So I'm now going to hand over to Ben, who's going to talk about sustainability much more in the context of the portfolios that we deliver to clients. So Ben, over to you.
Hi everyone. Sorry, we'll just do a bit of musical chairs to get me into the screen. So yeah, thanks Gillian. I'm Ben Popatlal. I work in the multi-asset investment team here at Schroders, and one of the responsibilities I have is basically to build the sustainability set of frameworks that we've built into the portfolios that we manage on behalf of clients. So I help to build portfolios and help to manage those portfolios, but also help to lead the efforts to integrate sustainability into the portfolios that we manage. And so to do that, what we have done, or the starting point for us really, was to come up with a set of frameworks. So how do we think about sustainability? What is it that we believe? What are the trade-offs that we might need to face? And in what ways will sustainability make its way into our investment process? So I'll actually start on the right-hand side of this slide. Sustainability, just like multi-asset, is a multifaceted discipline. So it's only natural that sustainability will feature in the multi-asset investment process on a number of different fronts. So we undertake research. Some of that research doesn't necessarily result in changes that we might make in the portfolio, but it does give us a better understanding about the long-term trends or the way that the way that customers and businesses are behaving out there in society, and how that might impact the future profitability of businesses, for example. So some long-term research to help us try and understand the themes a little bit better. Asset allocation, so this is more, I suppose, tangible, things that we might buy in the portfolio that actually express some of our sustainability related views or ideas in the portfolio. And then finally, portfolio construction. So again, not everything has to be tactical or day-to-day, but rather you can build your portfolio with a set of goals that might not have featured in a portfolio that doesn't consider sustainability. So research, asset allocation, and portfolio construction are three fronts on which we integrate sustainability into our multi-asset portfolios. So I kind of did this slide backwards, but on the left-hand side of this slide, this is a core part of our philosophy in multi-asset, and this is that sustainability is a two-way thing. So things that happen out there in the real world, they can affect your portfolio. So this is what we call inward materiality. So something that happens out there in the real world, how does that affect the things that I invest in my portfolio? So basically, this is, we've labeled it climate risk, but sustainability related risks and opportunities that we might want to avoid or take advantage of in the portfolio. Now, all portfolios should be considering inward materiality of sustainability. If you're not considering climate risk, then you're not considering all of the risks that you could be considering in managing the portfolio. So climate risk is just another risk. Sustainability risks are just risks, and they also present opportunities to us. So we do think it's a relatively low bar. All portfolios should be considering inward materiality. The higher bar for portfolios to consider is the outward materiality. So that's the impact that your portfolio has on the planet or on the real world. Now, some clients might not have those types of objectives built into their portfolio, but many clients will. So that's a higher bar for sustainability. It is the purer form of sustainability. It's some of the things that Gillian was talking about. That's how we have an impact out there on the real world. But again, sustainability is a two-way thing, and I think it's important to distinguish between the directions in which sustainability goes. So moving on to one of the key frameworks that we use, or one of the things that we consider when we think about sustainability in our portfolios, is that we consider, again, risk scenarios or perhaps risks and opportunities that could face us in the short term. So, people think about sustainability as being a very long-term thing. The journey to net zero in 2050, climate change being a relatively slow-moving thing, but actually financial markets can price in information into asset prices in the very short term. So there are a number of things that can happen: announcements on changes in policies, big shifts in consumer tastes, new laws that might be passed. Also things, of course, like the Russian invasion of Ukraine. These can throw spanners in the works that we will need to consider when we manage the portfolio. And so we've listed, on the right-hand side, some of them more important, some of them less important, but this is a brainstorm that we do regularly amongst our team to come up with certain sustainability risk scenarios that could impact our portfolio. Now, we've labeled them on the right-hand side acute, not acute would be perhaps chronic or dormant risks. So chronic risks, they remain, but they're affecting the things that we invest in a slightly slower moving way. Whereas acute risks can happen at any time, and they will have big impacts on the things that we invest in. So I've just kind of drawn a few out on the left-hand side there. There's energy security upside and downside that we could envisage. So there's positive and negative scenarios that could come up. Weather risk, of course, and that's actually different to climate risk. Weather risk could be things like falling water levels in the Rhine, which affect industrial productivity in Germany, for example. And then, of course, war as well, which has been a key focus recently. So these scenarios are a key part of our process. This is moving on to the kind of asset allocation part of it. We can invest in carbon allowances. These are, particularly the European emissions allowances that we can buy. Basically, what this does is, the emissions allowances market creates a price for carbon that industrial emitters in Europe have to pay in order to have the right to emit carbon into the atmosphere. This is a tradable market, and so by partaking in that market, we are supporting efforts by European regulators to build a price around carbon. Now, for us in a multi-asset portfolio, this is not all about, is the price going to go up and therefore we should buy it? Is the price going to go down, therefore we should sell it? What we do with all of the assets in our portfolio is we try to understand how they relate to the other assets that we invest in. So on the right-hand side, you can see that European emissions cluster, or they correlate with commodities and gold. You can see the equities correlating together or clustering together, and you can see the bonds clustering together. This is a chart that we look at very regularly for all of the assets that we invest in to try to understand how things will fit into our portfolio. But investing in carbon allowances is something that we're doing on the asset allocation front. Commodities is one that people have suggested is a difficult one. No, it is a difficult one. The reason commodities is difficult from a sustainability perspective is that commodities have a life cycle. They are produced, perhaps extracted out of the ground or from the seabed, and then later on they are used in some way. Now, the use of commodities is probably often good from a social perspective. We need energy in order to power our industry, in order to power our homes, but actually the burning of a barrel of oil is somewhat bad for the environment. So you have conflicting signals from the social and the environmental side of things, but also throughout the life cycle, where actually extracting a barrel of oil is not that bad for the environment. Burning the barrel of oil is worse for the environment. Now, if you flip that the other way around, on the metals side, extracting metals can be very bad for the environment and for biodiversity, but actually then many of those metals are being used in the energy transition. So it is a complex picture, but what we say around commodities is that we need to understand the life cycle, we need to understand the inward and outward materiality that I talked about earlier on, and ultimately we need to understand the differences between the different commodities and their conflicting E&S signals. But this is a piece of work that we've been doing in the last few months, and we're coming to a set of frameworks that we can build around commodities and multi-asset. And so, moving on to the portfolio construction side of things. Now, what we found is that the trade-off between, if there is a trade-off, the trade-off between climate improvement or sustainability improvement and the risk and return objective in your portfolio is non-linear. So it's not that the more you improve your climate, the more you give up on returns or the more you increase your risk. Not so. What we found is that you can improve the climate credentials of your portfolio to a certain degree without increasing the risk of your portfolio and without compromising the return of your portfolio. Then if you push sustainability too far, too fast, then you might start to compromise the investment integrity of the portfolio. So this is just one of the doodles that we've drawn in the last few months. But on the following slides, I'm going to show you the more kind of mathematical version of them, I suppose. Well, first, actually, before I get to the mathematical version of that chart, we've got a few charts on why exactly it is that we can't just get to net zero tomorrow. Why we can't just push sustainability all the way to perfection tomorrow or next week. And the first main reason is that there's simply not enough assets to invest in. On this chart, on the left-hand side, you can see the full universe of bonds that are available to invest in and the full universe of stocks that are available for us to invest in. Now, if you constrain the portfolio today to meeting a temperature alignment target, so the x-axis there is reducing your portfolio to below 3.2 degrees, below 2 degrees, and below 1.5 degrees, if you want to set that as an objective right now, today, then the universe of available assets that you have to invest in shrinks massively. So on the far right there just aren't a lot of stocks and there aren't a lot of bonds for you to put into your portfolio if you need to get to 1.5 degrees today. So that's the first reason why it's difficult to reach net zero today. This is a similar story. Basically, your industry and your country concentration in the portfolio increases quite substantially. So again, moving from left to right, that's better climate alignment. That increases your concentration to particular countries and particular industries. And again, that is starting to bite, or that's starting to compromise the risk and return integrity of the portfolio. So the sustainability target is kind of getting in the way of your risk and return target, but again, only if you're pushing it too far, too fast. This is another way of showing the same thing in numbers. Application software in the full universe has a 2.7% weight. If you want to align your portfolio with 1.5 degrees, application software will have an 11.1% weight. Now, you might like application software investments, and that might be fine for you. But if you don't, and you want to underweight application software, then you'll be reducing that, possibly increasing your temperature alignment, but also clearly you're way out of whack from where you started, which was 2.7%. So, and you can see again that number on application software increases kind of non-linearly. It goes from 2.7 to 3.1, which is not significant, and then it jumps to 5.3 and then jumps even more to 11.1. So again, pushing sustainability too far, too fast could be costly. And that's today, importantly, that's today. Before I go to the final slide, I'll stress that that's today, because one of the things that we need to do is try to understand the long-term evolution of supply of sustainable assets. So some of the qualitative research that we do, policy research, again, understanding consumer tastes, like I mentioned earlier on, will help us to understand to what degree more sustainable stocks and more sustainable bonds will come online and be available for us to invest in. Then we can improve the sustainability of our portfolio in line with the way that the world is kind of evolving. So I'll stop there and pass back to Gillian, and we can answer any questions, I think.
Thanks, Ben. And hopefully that was a quick summary of why we can't reach net zero today. I always think that's fascinating in terms of what's happening. We're keen to move on and spend some time asking or answering your questions, but just before we do that, hopefully this session's been able to help you consider the sustainability credentials of your business and why that might be helpful. And as I said, we're happy to share the scorecard, 20 quick questions about your business that you might just find interesting and thought-provoking. Explain what net zero really means and why it's important, understand the impact this could have on clients' portfolios, and then lastly, which Ben articulated, I think, very well, why we can't reach net zero today. Just before we move on to questions, as a reminder, we run a range of sustainable model portfolios within our overall Schroders investment solutions range. So you'll see on this chart here on the left-hand side under model portfolios, we have 6 model portfolios. They're available across a wide range of platforms, and we have a starting management charge of 15 basis points. What's really important to me in terms of how we run that solutions business is the support that we give to advisors, not just in our range of webinars, the documentation and the support and the content that I spoke about earlier in terms of our guides, but also regular quarterly updates in terms of investment performance, but also the sustainability report that I highlighted and our monthly performance update. So that's just a quick update on our solutions business. If you do want any more information on the solutions business or anything else that Ben and I have talked about today, we're always happy to help, and here's how you can get in touch with us or just contact either of us directly. I'm sure you can find us. So with that, I'm now going to hand back to Andrew to chair the Q&A session.
Well, thanks, Gillian, and thank you, Ben, also for 2 really insightful presentations. Yeah, we've got 10 to 15 minutes of time for questions and answers. Haven't seen many in the chat box so far. So for those of you who do want to ask questions, do please go to the chat box and type your questions in there. If you want to ask them anonymously, again, just select my name from the drop-down menu, and you can send it directly to me. I will ask your question anonymously. There was a question earlier on, actually, just a general one, asking if you can get a copy of the slides to the whole presentation. Yes, indeed you can. We'll be sending you a link to the recording of this whole presentation, which you can find on our YouTube channel, and you'll find that in the email that you'll be receiving tomorrow. Somebody also asked how can people access the sustainability card, and if you look on the chat function right now, you will find a link to that. It's a message from Hayley McNeil to everybody, but we will also send you that link in the email tomorrow. So we have had a question in: do all your portfolios target eventually net zero or just the sustainable ones, Ben?
So yeah, it's not all portfolios that will necessarily have a target. All of our portfolios will integrate sustainability into the investment process. So all portfolios will take account of sustainability related risks and opportunities, and we will undertake sustainability related research that will feed into the management of all of our portfolios, but not all of them will have explicit targets around sustainability. Again, we manage pooled funds on behalf of pooled funds which many investors can invest in, and so they will have, again, differing targets around conventional things like income versus capital growth, but then similarly on the sustainability side. And then we manage segregated portfolios for institutional clients, for example, who again can kind of articulate their specific sustainability objectives. So it will differ across the board. It's not kind of a one size fits all necessarily, no.
Okay, sure. Sorry, another couple of questions coming in. I'll ask one of my own at the moment. What about exclusions? Do you exclude companies or countries from your portfolio, Ben?
So there are some high level kind of top down, no-brainer exclusions, if you like. Unconventional weapons, controversial weapons, that is, unconventional oil and gas, things like this. And then there are some somewhat softer exclusions whereby there's a revenue threshold, so things like perhaps tobacco or alcohol. So some of those are imposed from the top down because it's a belief of Schroders that we should do that. Then some specific portfolios will take that step further. They'll either apply stricter revenue thresholds to particular exclusions, or they will exclude, again, a certain number of different industries, for example. So the exclusions can get somewhat more severe as you go along. However, we don't believe that exclusions are the most potent tool, if you like, in terms of pursuing your sustainability objectives. We do think that owning a company and actively owning that company, engaging with the company to help it improve, that is the more potent tool, especially in the equity space. So, we work with our central sustainability team at Schroders to formulate an engagement strategy, and it's one of the lines that we're taking at Schroders, which we believe is crucial for making progress, rather than just kind of kicking out the worst offenders, basically. So there's definitely a mix between exclusion but also active ownership.
Okay, thanks very much. One for Gillian here. Gillian, what's been the response so far to the Sustainability Scorecard?
Yeah, it's actually been extremely positive. I'm currently delivering the scorecard at events and our regional events at the moment. Every time I've presented, it raises really interesting discussion in the audience, and sometimes quite different discussions. We had a really interesting one on renewable energy suppliers the other week, where the audience talked about, what's available and how they can get more information. We talked a lot about how smaller businesses can reduce their emissions, some of the steps that they can take. But actually last week's event ended up in a very interesting discussion on diversity and inclusion within businesses. I'm at times, and how we can maybe help advisors think through that. So I think what's been great is that the advisors have given us some really good feedback. And I think it's also important to note that the scorecard is just for advisors to think about their own business. It's not about giving people gold stars or black marks. It's about does it create some discussion amongst the business. I presented at an event
We seem to have lost sound from Gillian and Ben at the moment. I can hear you now, I think, Gillian. No, we can't hear you. We seem to have lost sound. I'm just concerned. Is that just me? Would anybody else on the call just like to quickly turn their microphone on and tell me whether they can hear Gillian or not? No, we seem to have lost sound, Gillian. I'm sorry. No, and others on the call can't hear it. I'm sorry about this, ladies and gentlemen. We're trying to get things fixed. We'll give it just a couple more moments, but if we're unable to fix it, then I'm afraid we'll have to draw the call to a close. But what we will do is we'll ask you, if you do have any questions for Gillian or for Ben, if you'd be kind enough to just send me an email, or actually respond to the email that you're going to get tomorrow from Joe Gilby. We will make sure that we put those questions to both Gillian and Ben. I can see them looking and wondering what's going on, as are we. Guys, I'm very sorry about this. It does look as though we are going to need to draw this to a close because we can't get the sound back. We still keep trying. Perhaps whilst we're still trying, can I? No.
It'd be better to log out and rejoin, I would say.
That's a very good idea. Gillian and Ben, if you can hear me, just if you wouldn't mind just trying to log out and rejoin. We'll see what happens with that. Whilst they're doing that, let me just recap for you on one or two events that we're running later in the year. So we are, if you happen to be in the Bristol area tomorrow, we are running our ESG roadshow at Lee Court in Bristol, and on Thursday we'll be in London at 1 Whitehall Place near to Embankment Tube Station. So if you can make it along to either of those venues, you'll be rewarded with a real variety of presentations from Albemarle Street Partners, Bailey Gifford, Eden Tree, Pictet and Quilter, all of which will be rounded off by a keynote presentation from Square Mile Research's Jock Glover. Trust me, it really will be a morning well spent. Next Wednesday, the 26th, we'll be back with another online working lunch. We'll be joined by Bailey Gifford's Claire Shaw, who'll be giving us the latest views on the long-term future of Scottish mortgage in a presentation entitled Knowing Your Circle of Competence. On the 9th of November, it's Aberdeen's turn to face the music at one of our digital working lunches as 3 of their PMs discuss the importance of diversification in an ever uncertain world. And finally, in November, our At Retirement Roadshow gets underway in Harrogate on the 15th. And we'll visit Knutsford on the 15th, Birmingham on the 16th, and the following week, you'll find us in Bristol on the 23rd and London on the 24th. Our sponsors here are Aviva Financial Advice, Bourdieu, Canada Life, Dynamic Planner, Legal and General, LV, and Simply Biz. So all in all, that's a total of 8 hours CPD, and you can find all the details of and register for all of these events on the Professional Advisor website under the Events tab. Now, let me just see if we've had any luck in getting Gillian and Ben back. It doesn't look as... Oh, here's Ben. Hello, guys.
I wonder if you can hear us now.
Yes, we've got you. We have.
Sorry about that.
No trouble at all. No trouble at all. So, Gillian, you were sort of talking about the what the response to the scorecard had been, and clearly, it's been there's been tremendous uptake. It's quite wide-ranging, and so I was wondering what kind of training and support are you able to give advisors?
Yeah, it's a great question, Andrew, and apologies to everybody. I don't know what happened with our laptop here. The key, one of the benefits is advisors having gone through the scorecard are saying, are there areas we can help with? And one of them is certainly around reducing emissions, and we're going to work with our sustainability team to look at how can we help in that area and how can advisors think about it. Because I think we've got a bit of work to do, but it's great we need to take that feedback on board. Secondly, the gender pay gap. Many advisors, as I mentioned in the session, for various reasons don't look at this, and we're working with our HR team to put together just sort of high-level key points for advisors to think about in terms of, not necessarily doing full reporting on gender pay gap, but what might they want to think about, and similarly with D&I policies. But the other important area is just generic training, and so again, we found over the last year that advisors are on a journey with their training, and some want very detailed training. We've had a webinar series, for example, on a number of quite detailed topics, but many advisors are also saying, could we just get some really basic introductory training, which is what our online training does. So for us, it's about taking the data back and then using it in a positive way to help advisors with their businesses. But as an example, I ran a session a couple of weeks ago and one advisor said, I've gone through all the 20 questions as you're speaking, and half of these are not really on my radar and I need to think about it. And half of them, I'll probably score myself, fair to middling, so to speak, which is great because he said he was keen to go back to the business and look at some of the questions in a bit more detail. But think about it in the context of if I adopt some of these practices, will it make my business more valuable in the longer term, but also a better place for my staff. So if we can help advisors drive some often quite small changes, then I think that's got to be a good thing.
Okay. I'm just checking again to see any other questions have come in. I don't think so, but I've got a couple more. Ben, obviously, there's an awful lot going on at the present time, and on one of your slides, you talked about sort of acute events. Has the Russian war changed the outlook for the energy transition?
Yeah, I think it's something that it has, and in some ways it's slowed it down, and in other ways it's sped it up. I think in the very short term, it's probably slowed it down because there's been this focus on energy security as opposed to energy transition. But actually, the definition of the energy transition, as per the UN and other international bodies, even a few years ago, even before Russia, the definition did include energy access and energy security. So specifically energy access. So that was making sure that energy was available to those people in the world that didn't have access to energy. So it wasn't just all about moving from a dirty energy to clean energy. Obviously, that was a key part of it, but energy access was a key part too. Now you've got energy access problems or energy security problems in the developed world. So that's coming to focus. So these pillars of the energy transition, energy, clean energy, energy access, energy security, they're coming more and less into focus as we go through this energy crisis, particularly in Europe. I think global supply chains will change, they'll reorient. I think energy diversification or the diversification of supply of energy into Europe will come into focus as well. So yes, there are a number of things that have changed, sped up and slowed down, but I think the general trend towards, again, energy transition, cleaner energy is definitely still intact. And actually probably the urgency for it has been brought to light by the recent situation. So, yeah.
Okay. And you showed a couple of interesting slides also, Ben, around the number of bonds and equities currently available that would immediately address the issue or take us to 1.5 degrees. That was a staggeringly low number at the present time. Are you seeing an acceleration in the number of bonds and funds that will meet that target sooner than later?
Yeah, I think we're seeing an increase in the number of individual securities at the stock level and bond level and the bond issuer level, and we are seeing improvements at that level. And if you think about it, a portfolio of securities can improve its climate credentials simply by the things that it invests in, improving their climate credentials. And I think that's why engagement is such an important tool for us, because it's not all about new companies coming into play, but actually some of those existing companies improving. And some of those companies have a massive footprint in the world, not just, I didn't even mean carbon footprint, I mean economic footprint in the world and social footprint in the world. But actually we do need those companies, and we just need them to improve their climate and sustainability credentials. So yes, we are seeing improvement at the security level. And I think that it will be the case that portfolios of securities will be held to higher and higher bars or higher and higher standards as we go forward. So yeah, I think we are seeing progress.
Well, that's encouraging to hear. I just having a final quick scan of other questions, and I can't see any. So I think that's it from me. It seems like a good time to perhaps draw things to a close. Once again, apologies, ladies and gentlemen, for the sound issue earlier on. I hope that hasn't detracted too much from your afternoon's session. All that remains for me, therefore, is to thank our speakers, Gillian and Ben from Schroders, for what I hope you'll agree was a really insightful and interesting session. Our biggest thanks, of course, as always, go to you, our readers, for your company this lunchtime. I trust you found this past hour helpful and worthwhile. And if you did, perhaps we'll see you again soon. Goodbye.